Everybody, this is Gary Dean with Sentiment Timing, and this is our technical video report for Thursday, January 11th, 2024. We saw the CPI numbers come in a little hotter than expected, but really the main thing is it kind of handcuffs the Fed, where the inflation stuff that's coming out, even food prices are at the highest ever right now, and like a lot of their gouges that they base inflation on, it excludes food and energy. So inflation is not going anywhere. Anybody that is really truly buying, believing that the Fed is going to cut six times in 2024, I think they're hallucinating right now. I don't even know if they're going to do three, me personally. But the reason why I'm bringing it up is because it's the Fed front and center again, as far as where we are and how we got here. And it had to do with the Fed pivot. And from there, everybody was, buying like QE was coming back out again. And that is not the case. And like I said, I'm not even sure they're going to do three in 2024. But in any case, I want to just bring you through the technical aspects of things. And we know when Woody's looking for the top. It's still a little bit away from now, but I want to show you how it actually could play out with where we are right now. Because no way do I believe that we're heading straight up into the spring. There's really no rhyme or reason for it, and I don't know what the catalyst would be. It's not going to be that the economy's doing better. The economy's not. It's not going to be that the Fed's going to be cutting rates six times. They're not. I don't know what the catalyst would be exactly for, the markets to run straight up into the springtime. So let's assume that we're going to take some kind of break somewhere around here. This is where it would make sense, because this is a weekly chart on the S&P. And if you notice, we don't have any bearish divergences here. We passed this, so right now we don't have the bearish divergences. And typically, when we see the tops, we do have, or where we're going to get a nice big drop. We see bearish divergences. So they're not here. But for this to actually start coming down again, we're going to need to see a move down. Even coming down to the 4380, maybe 4400, that will then bring this down and set up the springboard into the spring. And that from there, when everybody, the euphoria is as high as it is, that's when they pull the rug out, and we probably see this market come down and test levels that a lot of people are not expecting, especially in an election year. So what this is saying is that this is not the top right here, in that we need to see some kind of divergence form, and the only way that's going to form is going to be if we start seeing our momentum indicators start to turn down, and then price pops back up. That gives you the bearish divergence. So if we look at the daily chart, here we have bearish divergences. This is what I'm looking for in the weekly chart. So the reason why I'm showing you that is these typical divergences, they don't just produce 100-point drops. They're usually anywhere between 2 and 400. And the premium reports that I've been showing, I have now four different intermediate term indicators that I'm showing that are giving sell signals. They've been ignored, but you have the put call ratio that hit extreme levels that typically produce pretty significant drops. Then we have the stocks above the 50-day moving average. That was at nosebleed seats, nosebleed levels, and again, it's typically anywhere from a 2 to 400 point drop on the S&P when we see that. And today, with the spike up after the CPI numbers, which really didn't make a whole lot of sense, and I explained that in the morning notes that it could be just the master planners trying to make everybody believe that everything's okay, and they're bidding the market up, and then they'll pull the rug out, and that's pretty much what happened. But we went right down to the I believe it was I'll show you in the other charts, but one of the moving averages, and again the buy program kicked back in again, and we closed pretty much unchanged. But here the daily chart, and again the other charts that I just talked about, that's hinting that we're going to see anywhere from a 2 to 300, maybe even a 400-point drop from here. So if that happens, seeing a move down to the 4,500, but more kind of likely would be down to this 44.21 that will close this gap. Now, if that happens, then what's going to happen is you're going to start seeing our momentum indicator dip down. And from there, it springboards back up, makes new highs, probably new all time highs. And we get the bearish divergences, and everybody is bullish on the market. And from there, we probably see a larger drop. But in any case, I mean, the larger drop and all that stuff, just, I mean, don't pay too much attention to that. I'm just really showing you a roadmap that would lead to a top in the spring, and that would be some type of pullback to start anywhere up here. Maybe we need to see new highs first. I don't know, but the way that it is we should see a drop down, and again, 44.21 makes perfect sense with it. We definitely get some kind of bounce right around this 4600 because one, we have price support, and we also have the 50-day moving average on the daily. But if it came down and then popped back up again and then down again, that would trap a lot of people and have us getting down to these levels in a fairly quick manner. And then from there, we pop back up. So I don't know where the depth bottom will be on this, but I'm just saying some type of pullback would be necessary to start giving these bearish divergences on the weekly chart. So if we look at a 60-minute chart, here you can see we have bearish divergences right here. We came down to the 50-day moving average. The moving average buyers stepped in, and they bid the market up to just down to about 3 points. But at the lows here, we were down over 35 points. So you can see people are getting a little skittish up here, meaning that they're not just bidding it straight up like we saw here, and especially since the whole focus of the Fed cutting rates 6 times, it's getting flushed down the toilet with every inflation report we see. So anyway, this is obviously what the Bears need to get through. If they do, then I'm anticipating we're coming down to the 46. We're going to test the 200-day moving average, which would be the 46.86 level. And if it breaks that, that's where we start running into just air until we touch this 45.37 level. So this would be really the next support level if this gets taken out. So this would be, let's just say the bull bear line would be below the 46.86 level. If that does it, that's when I'm anticipating we get the quick drop down to there. Now, again, if we head up, we have the 48.18, which was the previous all-time highs. So that's going to be some major resistance. And if we just take a look at the 15-minute chart, you can see that we made it down. This is the 200-day moving average. And then again, buyers stepped in. But we had bearish divergences there. We didn't have any bullish divergences. So again, it's one of the things that, this buying the dips right here, it works until it doesn't. And then when it doesn't, what happens is these buyers turn into panic sellers. But right now, the buy the dip pattern has worked. And this is what the Bears need to get it through this 47.40, really right below this 47.30. If they do that, we do have some support at 47.21, but more likely we'll be coming back down to these lows at the 46.82. So if the Bulls can get it above it, obviously we're looking at 48.18. If the Bears can take it below the 47.30, I believe we're coming back down and we're going to test this 46.82. So let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.